All right, everyone, how's it going? Hope you're doing great. TN Mortgage Podcast, episode number 18 with John Coleman.
I can't believe it. How are you, everyone? Episode number 18. John Coleman here, and hoping to give you all some good news today.
Yeah, absolutely.
That's the tease. No.
That's the tease. That's the big tease to keep them listening. And absolutely, we did get some good news for once. It seems like we've had years and years of nothing but bad news when it comes to interest rates. But last week, the European Central Bank opted to actually cut rates. And so you're going to give us a bunch of information and context about that and how it may actually or may not affect Irish homeowners and buyers.
Okay, well, it is good news, but I don't want to sort of say open the champagne just yet. Basically, what happened was, well, the interest rates were cut by 0.25%, from 4 down to 3.75. Now, that really was the first cut in 5 years, but it basically followed on 10 rises from July 22, but basically right up until October 23. So this was expected, okay, but in life, interest rates always have expectations. For years, they were saying they were going to go up, and they didn't. Now they were saying they were going to come down, and it was a bit later than some people had predicted.
All right, John, now let's actually hear some of the comments and the commentary from the European Central Bank President Christine Lagarde last week when they chose to reduce interest rates. And you mentioned it, it's interesting, not just the reduction in rates, but of course, their commentary based on what they're seeing in the future. So let's actually hear from her at her press conference.
Thank you very much, and good day to all of you. Today, the Vice President and I are delighted to welcome you to our press conference. The Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission, it is now appropriate to moderate the degree of monetary policy restriction after 9 months of holding rates steady.
There's a few things I want to discuss. First thing will be what will actually the impact. Okay, well, the question will be in Ireland, until the banks follow through, okay, it may not have any impact immediately, but they will follow through, but it'll be a matter of timing. Because when the rates were going up, the banks didn't increase the rates at the same pace that the European Central Bank were. So the question is, at what pace will they start to reduce them now? Okay, so that's the first thing to keep in mind, that unless you are an existing mortgage holder and are on what they call a tracker mortgage, which are things on the past which only a small percentage of the population would currently have, then you won't benefit from this day forward. But each of the bank will be looking at how they play this and how will they potentially get a competitive advantage. Do they move first? Do they move last? Do they move in the middle? It will happen. It will just depend on when. Some banks have preempted this and actually reduced their rates before this has already happened. So they were getting ahead of the game. Now it's a case of, well, how does it all pan out? A lot of that will then depend on future expectations, okay, as to what is the market forecasting will happen with the next interest rate review. Now, prior to Thursday, the view was very much that this rate would be happening, okay? And then it was going to be a case of, well, how quickly would the next set of reductions follow, okay? What's always key at these meetings is the commentary that goes with it, okay? It's not just the actual summary headline announcement, rates have fallen. It's the context that go with it, and then how the so-called experts interpret the meaning behind the message, okay? So the message that came out on the back of this was one of caution, one of, yes, we're reducing the rates now because we think we've got inflation under control, which is the key thing around this. It's about keeping inflation under control. But we're now more worried than we previously were. The risk of inflation going back up is now greater than it was than they feel it was coming back a bit further going down. So with that layer of kind of information or subtext around the reduction, the speed at which the rates may come down does seem to kind of taken a view whereby, oh, it mightn't be as quick. Okay. So if that happens, well, then there's a bit of a waiting game as well as to when it's going to happen. And then if the European Central Bank is saying, well, we might be reducing them again, then the banks will go, well, okay, what do we do now? Okay. And there's a judgment call on to be made from the banks on that and when. The implication on there's always a secondary implication with interest rates is house prices. Okay. As I've mentioned to you many times, in the period of October 22 to July, whatever, when the rates went up by nearly 4%, prices did not fall. Okay. So I've been saying, and you might remember my predictions at the start of the year, where if rates were to come down, that I would see the prices going up by more than if they remain the same, because there's still a big gap between supply and demand. So with this piece of information that rates have come down by 0.25%, until the banks actually bring it to the market, it'll have no immediate impact, because the banks won't be lending any more money to people until they view it off a lower interest rate. So it won't have any immediate impact on the supply and demand function. So it shouldn't push prices up any more than they might be going up with as it stands based on the current gap between supply and demand. But if there were to be a second, and this is what I said at the start of the year, if there was to be a second or third one, which seems less likely right now based on the current piece of information, well then the prices may increase at a greater rate than they had been having. So while yes, it's great that your repayments have been lower, the opposite side of that is the prices might go up. So that's something to keep in mind. So I think the advice I've been giving to people is, when the rates are going to go up, if you're buying a new house, try and buy it now, right? When you know the rates if they're going to fall, rates are going to fall. If the rates fall, you'll have bought it before the prices might go up. But again, as I say, with interest rates, in every conversation I have with everyone, there's a bit of crystal ball stuff going on here, right? We're working on best case of information. Like, while yes, we headline this as good news, it's good news in that it's happened. If you were expecting more interest rates to sort of a sequence of interest rate reductions, well, this could now be viewed as bad news. And it depends on how you would view it. Now, interest rate reductions, in my view, is always good news. But it's like, if you think you're going to win a certain amount of money and you only get half it, is it? Again, it's all about perception.
Yeah, like you said, I think you said it best. Don't pop the champagne just yet. And it's we could be cautiously optimistic that maybe more rate increases are coming, but it's all about inflation.
Decrease. Yeah, no, it is all about the inflation, and the expectation in Europe was that the inflation would be about 2% in 2025. The now expected mark is 2.2, which is a little bit above. So I don't want to get into minute details here, but because it might throw our listeners pressing the snooze button. But this is how the central bank operate, right? So the expectation around inflation has increased slightly, which, if that's the thought process, well, then they're going to be less likely to reduce rates into the near future. So watch this space, basically,
Yeah, and for just the person maybe who's in a home now and has a mortgage and looking to switch, or someone looking to buy, what advice would you give them? I know you mentioned with new homes, but how could they somehow benefit if rates are on the downswing through the rest of 2024?
Well, let's answer the first part of that question first, as in people who are actually in their homes at the moment. And, well, it depends on what type of rate they chose in the first place, okay? if they've taken a fixed rate and their fixed rate period isn't ending this year, they don't need to worry about it for the moment, okay? Because they're locked into a rate that if they had the foresight to take a 3 or 5 year rate before the rates went up, they've been okay, right? They haven't been affected, but they will be affected when their rate period ends. So, but if you're coming off a fixed rate this year, okay, the question is going to be, do we take a variable rate now and hope that rates are going to come down? Or do we look to take a fixed rate now and then kind of just hedge our bets and say, right, well, actually rates may not come down, and we look at what the market is, even though it might be higher than what we were currently paying. So it's a difficult one to actually give a definitive piece of advice to. Switching, in theory, can make sense, but then you've got costs to a switch. You could have a legal fees. Now, there are banks out there that will offer kind of cash back to switch, but I'm not always convinced it's the right move. Right?
Yeah, you have to pencil it out. Yeah.
Yeah, I often tell my first, and I'm always talking myself out of business when I do this, by the way, right? My first point of call with every person is, well, there's a hassle with mortgage, there's a cost with moving your mortgage. Is it worth it? Are you better off sticking with the bank that you're with and looking to see what's the best option with that particular bank? Obviously, if you still want to move, I'm more than happy to facilitate it. But that's my first point of call, because if you're coming off a rate today and you're looking to move, it could take 2 to 3 months' time to go through that process. But by the time you come around to doing it, if rates are to come down, well, it mightn't have been the right call in the first place. Do you understand?
Yeah.
So there's, until you kind of get what I would call a stable interest rate environment whereby rates aren't moving at all, whether it's going up or going down, it's very difficult to actually make an absolute definitive call. You can make a definitive call today that could be redundant by a month, 3 to 4 weeks time. And that's why you've wasted a whole heap of your time starting on a painful process that it may not have made any sense, you know? So, like, from my own business point of view, I want to get back to the point where my rates are kind of static, because then there's more then there's business. Then it makes sense for me to recommend switching, or if you're looking to do some work on the house, it makes sense to move all your mortgage from one bank to the other. At the moment, I can't, in all consciousness, give that advice with the level of certainty that I want to, you know?
Yeah, well, that's great. People need to be informed, and it's great that they understand. A lot of people may see the headlines and, oh, great, mortgage rates are coming down, and that's not always the case or immediately. So when people do have questions, or they want to pencil out the benefit, or they could just call you, contact you, you're happy to go through it with them, correct?
Oh, absolutely. That's what I do for all my clients. Like, I will get in touch with them. Like, I've had a number of calls in the last week telling them about one of the banks that they're who I would have thought might have made sense to move. I'm ringing them up and saying, good news, your bank have reduced their rates. Stay where you are. This is the kind of advice that I'm giving them. My view on that is, if I'm telling 10 people stay where you are, they're saying, well, God, John's a good guy. I like to sleep easy at night, you know.
Absolutely. No,
and you do get joy out of giving good information to people like that.
Yeah.
I think I've said to you before in the past, once upon a time, and this is based on with my mum, I would have liked to be a teacher. So I view this, I think I've said this to you on numerous occasions, I view this role very much as an educational piece. And then obviously, if you do a good enough job educating people, that when there's business to be done, business will get done, you know?
Yeah, of course. And you always think about the long term and, like you said, earning the people's business with the best information and keeping their best interests in mind. So that's the whole point of this podcast, right? All right, John, that was great information. I'm sure that'll be of value to a lot of people who are listening. TN Mortgage number 18. And how should people get in touch with you if they do have questions?
Of course, the best is always email john@jcmortgages.ie. I spend my life on either appointments or answering my mail. So that's always the best way to get hold of me. And if necessary, we can always arrange an appointment to go through any specific questions that may need a phone call or conversation.
Absolutely. Well, yeah, everyone, thanks for tuning in, listening to Tea and Mortgage number 18. And we'll be back next month with some more great info for you.
All the best for now, everyone.